Picture this. You walk into a convenience store at 2 in the morning. The floor is sticky, the shelves are messy, and the price tags are flickering like a bad disco light. That is exactly what the silver market looks like in mid-February 2026. If you just woke up and checked your portfolio, pour yourself a strong coffee. Don't throw your phone across the room just yet. We just witnessed a liquidity slap. Silver plunged from a high of $85 an ounce down to under $75 in a matter of hours. $10 vanished, faster than a politician's promise. Meanwhile, gold is still sitting pretty at $5,100. People are screaming crash, but look around. Who is actually selling? Nobody. We are in a double ghost town. In the east, the Shanghai whales have closed up shop to eat dumplings for the Lunar New Year. In the west, the Wall Street pros are packing their bags for the President's Day holiday. The market is running on empty, staffed by a few interns and some high-speed trading bots. Liquidity is so thin right now that a single sell order echoes like a bomb blast in an empty cathedral. So, I need you to do one thing. Close the flashing tabs. Do not let these red candles trick your eyes. Before I expose the empty ATM machine over at the COMEX, tell me where you are keeping a cool head. Are you watching this from a rainy London cafe? Or are you snowed in somewhere in Canada? Roll call in the comments below so I know we are not the only ones awake in this ghost town. Let us peel back the layers of this onion and see why everyone is crying. If you were watching the live streams yesterday, you might have seen a moment of pure panic. Not because of a nuclear war, and not because the Federal Reserve announced they were insolvent, though that is technically true every day. No, the panic happened because a lizard walked behind a YouTuber. I am not joking. During a live market breakdown, a giant iguana appeared in the background, and the host jumped out of his skin. The chat room exploded. For a split second, the lizard was the most important thing in the global financial system. That iguana is the perfect metaphor for what happened to the silver price this week. The market saw a shadow, it saw thin liquidity, and it jumped. The algorithms, which are basically just nervous lizards with high-speed internet connections, triggered a cascade of sell orders. They saw the price dip below a key technical level, and they all rushed for the exit at the exact same time. But here is the comedy of the situation. While the price on your screen shows a $10 drop, suggesting that nobody wants silver, the physical vault data tells a completely different story. This is where we stop looking at the flashing lights and start looking at the plumbing. Let us talk about the COMEX warehouses in New York. Think of the COMEX like a giant ATM machine for the Western world. For years, people have walked up to this machine, put in their card, and assumed there was cash inside. But this week, the maintenance log shows something terrifying. The inventory level in the registered category has officially crashed below 100 million ounces. Specifically, we are looking at roughly 98 million ounces left. Now, you might say, 98 million sounds like a lot. It sounds like a mountain of metal. But in the world of global finance, that is not a mountain. That is a pebble. To put that in perspective, 98 million ounces is worth roughly $7.5 billion at current prices. That is less than the market cap of a mid-tier meme coin. It is pocket change for a company like Apple or Microsoft. We need to clarify a very specific lie that the bankers love to tell. They will point to the eligible category and say, look, there is plenty of silver. Do not fall for this 3-card Monty trick. Eligible silver is metal that is sitting in the vault, but it is not for sale. It belongs to someone else. It is private property. Counting eligible silver as available supply is like me looking at your car in your driveway and telling the bank that it is my asset. It is there, yes. I can see it, yes. But if I try to sell your car, I am going to jail. The only metal that matters is registered. That is the metal with a for sale sign on it. And that pile is shrinking fast. It has dropped 25% just since the start of the year. The ATM is running out of cash, but the screen is still brightly lit, inviting you to make a withdrawal. This brings us to the most dangerous game of musical chairs in history. Right now, there are roughly 65,000 open interest contracts for March delivery. Each contract represents 5,000 ounces. Do the math with me. That is 325 million ounces of paper silver that people think they own. But remember, there are only 98 million ounces in the registered vault. That is a ratio of roughly 3 to 1. 3 people think they own the same bar of silver. When the music stops, and the music is getting very quiet right now, only one of those 3 people is going to get the metal. The other 2 are going to get a check written in fiat currency, which is rapidly losing its value. This is the definition of a fractional reserve scam. And the market knows it. How do we know the market knows? Because of a phenomenon called backwardation. Normally, in a healthy market, the future price of a commodity is higher than the spot price. This makes sense. If you want me to store a barrel of oil or a bar of silver for 6 months and deliver it to you later, I am going to charge you for storage and insurance. So, The future price should be higher. But right now, we are seeing the opposite. The spot price, the price to get the metal right now, immediately is often trading higher than the futures price. This is a glitch in the matrix. It is a screaming siren. It means that the market does not trust that the metal will be there in the future. Traders are willing to pay a premium to get their hands on the physical bar today, rather than holding a paper promise for next month. This backwardation is the smoking gun. It proves that the price smash we saw yesterday was fake. It was a paper event. It was a derivative illusion. If there was really a surplus of silver, if nobody wanted it, the future price would be in a steep contango, meaning it would be much higher than the spot price. But it is not. So, why did they smash the price? Why drop it $10? It is the classic shakeout maneuver. They know the liquidity is thin because of the holidays in China and the US. They know that retail investors get scared easily. They push the price down to trigger your stop-loss orders. They want you to sell your real position so they can cover their naked shorts at a lower price. It is a Black Friday sale, but in reverse. They are marking down the price of the goods because they desperately need to buy them back from you before you realize how rare they are. They are banking on your fear. They are banking on you seeing the iguana and thinking it is a dragon. But the vault does not lie. The vault is emptying. The registered inventory is bleeding out. And while the West plays these paper games, the East is doing something entirely different. They are not looking at the paper price. They are looking at the weight. And that brings us to the other side of the world, where the real action is happening while we sleep. Now, let us look at the map. While the Western traders are distracted by flashing lights and giant lizards, a massive geopolitical heist is taking place in broad daylight. This is the part of the story where we stop talking about paper contracts and start talking about gravity. Because in the world of commodities, money flows to where it is treated best. And right now, silver is being treated like royalty in the East and like trash in the West. We are currently in a very specific time window. It is the Lunar New Year. The dragon is technically sleeping. The Shanghai Gold Exchange and the Shanghai Futures Exchange are closed for the Spring Festival. The Western bankers know this. They know that the biggest physical buyer in the world is taking a week off to eat dumplings and hand out red envelopes. This is why they chose this exact moment to smash the price. It is a tactical ambush. They waited for the grown-ups to leave the room so they could kick over the table. But here is the problem with their plan. Gravity does not take a holiday. And right now, the gravitational pull from the East is so strong, it is bending the laws of economics. Let us look at the numbers, because numbers do not have feelings. In Shanghai, before the market closed for the holiday, the spot price of silver was hovering around $84 an ounce, but that is just the sticker price. To get that metal out of the vault and into a factory, you have to pay a value-added tax of 13%. When you add that up, the real industrial price of silver in China is pushing $95 an ounce. Now, look at the price in New York or London after this recent smash. It is trading around $76. Do the math. 95 minus 76. That is a spread of $19. Even if you factor in $2 for shipping, insurance, and armored transport, you are looking at a risk-free profit of $17 for every single ounce you move from west to east. This is not just an arbitrage. This is a smuggler's dream. It is an economic black hole. If I told you that you could buy a brand new iPhone in New York for $500 and sell it immediately in Beijing for $800, what would you do? You would not just buy one. You would charter a cargo plane. You would empty every Apple store on the East Coast. And that is exactly what is happening to the silver vaults in London and New York. The metal is flying away. It is moving from the vaults where the price is suppressed to the vaults where the price is real. The Western banks are smashing the paper price to save their short positions, but in doing so, they are putting the physical metal on a clearance sale for the Chinese. It is a self-defeating loop. The cheaper they make it, the faster it leaves. We have the receipts to prove it. Look at the inventory data from the Shanghai Gold Exchange. Since 2020, the silver stocks in Shanghai have plummeted by over 90%. They are down to the bone. Just this past Monday, right before the holiday break, we saw a drawdown of 8 to 9% in a single day. Think about that. Nearly 1/10 of the entire available inventory was scooped up in 24 hours. That is not retail investors buying coins for their grandkids. That is industrial panic. That is strategic accumulation. This is what a run on the bank looks like in slow motion. The solar panel manufacturers, the electric vehicle makers, and the military contractors in the East know that silver is finite. They see the deficit. They see that the mines are not producing enough, and they are using this price smash as a gift. While you are panicking because your screen shows a red candle, the smart money in the East is backing up the truck. They are draining the West dry. This creates a massive vacuum effect. The Shanghai vaults are empty, so they suck in metal from London. London vaults get low, so they suck in metal from New York. and New York is already down to 98 million ounces in registered. The West is trying to play a game of poker using paper cards, while the East is collecting the chips. The irony is absolutely delicious. The bullion banks think they are controlling the market by dumping paper contracts, but all they are doing is subsidizing the industrial dominance of their geopolitical rivals. Every time they smash the price down to $75, they are effectively writing a discount check to a solar factory in Shenzhen. They are bleeding real assets to defend a fake price. And this brings us to the history books. We have seen this movie before, but never on this scale. We saw it with the Hunt brothers in 1980. We saw a glimpse of it in 2011, but this time, it is not two guys from Texas trying to corner the market. It is the entire manufacturing base of the Eastern Hemisphere, realizing that they cannot build the future without this metal. The dragon might be sleeping for a few days, but its vault is wide open, and the vacuum is still running. When the Chinese markets reopen next week, and they see that the West has put silver on sale for $10 off, what do you think they are going to do? Do you think they will sell? Or do you think they will take the rest of it? The smuggler's route is wide open, the arbitrage gap is screaming, and the supply is vanishing into the cargo holds of ships and planes, heading one way, west to east, paper to physical. We are watching a wealth transfer of historic proportions, disguised as a market crash. And the most terrifying part? The people selling right now have no idea they are being robbed. So, we have established that the bankers are playing games with paper, and the smugglers are flying planes to China. But there is a third player in this story, and this player does not care about charts, moving averages, or what the Federal Reserve Chairman had for breakfast. This player is the hungry monster of modern industry. While traders are hyperventilating over a $10 drop in price, the industrial complex is quietly eating the world's silver supply alive. You see, silver is not just a shiny rock that pirates bury in a chest. It is the best conductor of electricity on the periodic table. It is the blood in the veins of the digital economy. Think about it. You cannot have a green revolution without silver. You cannot have an electric vehicle revolution without silver. You certainly cannot have an AI revolution without the massive servers and chips that require silver to function without overheating. We are currently in the 5th consecutive year of a structural deficit. Let that sink in. For 5 years in a row, the world has consumed more silver than the miners can dig out of the ground. This is not a cycle. This is a math problem. The solar industry alone is now devouring nearly 20% of the annual supply. And these newer, more efficient solar panels, they use even more silver than the old ones. They are gluttons. Here is the comedy of the situation. When the price of silver drops on the paper market, does a solar panel manufacturer in Shanghai say, "Oh no, the chart looks bearish. Let's stop making panels"? No, they say, "Thank you for the discount," and they buy more. This price smash is actually accelerating the shortage. It is like telling a starving teenager that hamburgers are now 50% off. You are not going to save money. You are going to run out of burgers twice as fast. This creates a bizarre reality where the spot price on your screen becomes completely detached from the real price on the street. Go ahead, try to buy physical silver at $75 right now. Call up a dealer. Walk into a coin shop. You will be met with laughter, or worse, you will be met with the dreaded out-of-stock sign. The premiums on physical coins and bars are exploding because the dealers know the truth. They know that you cannot print silver. You cannot quantitative ease a precious metal into existence. You have to find it, dig it, refine it, and ship it. And right now the mines are tapped out. The easy silver is gone. The ore grades are falling. We are scraping the bottom of the barrel while the demand for high-tech weaponry, aerospace, and medical electronics is going vertical. Remember the registered inventory crashing below 100 million ounces? That is not just investors taking delivery. That is industry panicking. Companies like Samsung, Tesla, and huge defense contractors are realizing that just-in-time delivery does not work when the warehouse is empty. They are moving to just-in-case inventory. They are hoarding. And unlike gold, which sits in a vault and can be melted down and resold, industrial silver is often consumed. It goes into a cruise missile that explodes. It goes into a landfill inside a discarded iPhone. It is gone. It is chemically dispersed. It is not coming back to save the COMEX. So, while the algorithm bots are busy painting red candles on the chart to scare you, the physical reality is that we are running out of the very material that makes the modern world function. The price is lying, but the supply chain is screaming. The hungry monster is still eating, and the buffet is closing. And when the industry realizes there is no metal left at any price, that is when the real panic begins. Not the panic of selling, but the panic of buying. So, where does this leave us? We are standing in a ghost town, watching a glitchy ATM spit out paper receipts, while the real money flies to China on a cargo plane. The lizards are jumpy, the algorithms are confused, and the price on your screen is lying to you. Think of this market like a beach ball being held underwater. The bankers are using every ounce of their financial muscle. The paper contracts, the margin calls, the price smashes to push that ball down. They want you to believe that the ball belongs at the bottom of the pool. They want you to believe that silver is worthless, that it is just a barbarous relic, a shiny pet rock. But here is the physics of the situation. The deeper they push that ball, the more pressure builds up. The harder they smash the price while the warehouses empty out, the more explosive the reaction will be when they finally lose their grip. And make no mistake, their hands are slipping. The registered inventory dropping below 100 million ounces is the sound of their grip failing. You have two choices right now. Scenario A. You let the fear win. You look at the red candles, you listen to the panic on the news, and you sell your real assets for paper currency that is being printed into oblivion. You hand over your wealth to the very people who are trying to trick you. You become the victim of the iguana effect. Scenario B. You realize this is a game. You see the out-of-stock signs at the dealers. You see the solar panels covering the roofs. You see the arbitrage gap screaming at $19. And you do nothing. Or better yet, you treat this $10 drop as a gift. You buy the discount that the desperate bankers are offering you. Do not try to be a hero and trade this volatility with leverage. You will get wrecked. This week is for watching, not gambling. The market is thin, the moves are fake, and the risk is high. My advice to you is simple. Don't believe the price, believe the weight. If you can hold it in your hand, it is real. If it is just a number on a screen, it is a promise that can be broken. The COMEX is running on fumes, the East is draining the West, and the industrial monster is still hungry. This ghost week will pass. The traders will come back from their holidays. And when they do, they are going to find a very different landscape. If you want the full forensic dossier, the charts, the vault data, and the specific levels I am watching for the breakout, the link is in the description below. It is not for everyone, but if you made it this far, it is probably for you. Pour another coffee, check your stack, and remember, in a world of paper lies, the truth is heavy. Stay safe.